Folks, welcome to week 8, and thanks for hanging with me over the last 2 months. I hope you have enjoyed the course, and I hope that we're concluding here with a subject that is of interest to anybody. And so if there's nothing that's really captured your interest to this point, I certainly hope that this will. We're talking about simulation here in week 8 of the course, and I hope this example will sort of drive home the idea of simulation and its value. The scenario I have for you here is, regardless of how old we are, I think everybody is at least has one eye on retirement planning, and being able to have some money when we retire that helps us sustain some sort of lifestyle that we've become accustomed to during our working years. And one of the things that we typically think about as we're retirement planning is, how much money am I going to have at the end of my working years? And if you make the assumption that everybody invests in the stock market and you do that on a fairly consistent basis every year, there's a couple ways that we could do this. Over the last 90 odd years of stock market returns, I think a common number that everybody hears is that the stock market has returned about 8% a year, and that's on average. And so one way that we could take a look at or estimate how much money we would have at the end of some number of years is, putting money in the stock market, multiplying it by 1.08 to figure out how much we have at the end of our first year, and then we add a certain amount of money the next year, and that again earns 8% interest. And so we sort of take sort of a linear approach here towards, trying to estimate what we would have at the end of our working years. And as I kind of pose here, if you look in the green block above, I'm kind of taking the long way around what I've said here, and really just want to get to the point. There is a really significant limitation to assuming that the stock market has earned a consistent return over the last 90 years and will do so in the future. And what I show you below the green box is stock market returns since 1921. And while you see here is a line that would represent you had that the market did not change from one year to the next. So positive returns above the line, negative returns below the line. And while we see that the stock market has been good to us in most years with some really pretty big returns, this starts in 1920. So this is about 1934. So here, some things we can point out here. Here is the Great Recession, where the stock market lost a lot of money. And then, of course, after you experience such turmoil and such really, really poor performance as you would expect, the market rebounded. And let's go out here to 2008, when we saw a nearly 30% loss in the stock market. But then, or since then, we've rebounded pretty well. And this would be, I believe this is 2017, where the market returned about 25%. So again, one thing that we mentioned in kind of looking at a consistent return over the course of our investing, while that is one way to do it, a better way to approach this, might be to consider the fact that the stock market has experienced extreme variation over the last 97 years, and figure out how we can use that to our advantage. And so if we consider that our retirement nest egg, I've given you this little function equation here, that our retirement nest egg is a function of how much we invest each year, our annual investment, and the stock market return. We certainly have control over how much money we invest each year, but we don't have control over the market. So we're going to see how a simulation here might help us have an understanding what we'll have after we've finished investing in our work years. Excuse me. By the way, this file will be available for you in the content area of week 8. And this is sort of the little assignment. I don't even want to call it assignment. It's just something we're going to have a little fun with, and we'll have some discussion on the discussion board about our results. So let me flip over to the simulation tab and let me explain what I've got to you here. In the first two columns, here are the actual numerical returns that I used on the previous page to make the visual. And I'm not going to make anybody seasick by scrolling all the way down, but when you get into this file, you can go down, and this goes from 1921 up to 2017, the year and the return. So over that 97 years, the average return has been 7.99 or just about 8%. And I think that's a number that everybody, if you pay attention to the stock market, that's a pretty solid number for the average return, historical return of the stock market. If you're familiar with statistical jargon, the standard deviation is 19.2, and that's essentially 19.2%. And that goes back here and explains the great amount of variation that we see in stock market returns. And we'll see why simulation then really becomes valuable in helping us consider the fact that there's a great amount of variation in stock market returns. So again, when you pull up the file, column A, column B, the year and the percent return from the stock market, and over the course of the last 97 years, about an 8% return with about a 19% standard deviation. And so here's what we're going to do. I have set up a little simulation here in Excel, and let me explain what I've done. I'm going to assume that we're going to invest for 30 years. And again, I don't want to make anybody seasick here, but let me just scroll down one time. And I've done this a number of times below, and I'll explain why. But we're going to consider 30 years of investment. So here's from year one to year 30. And here's what I'm going to assume. I'm going to assume at the beginning of each year that I put $10,000 in the stock market, and the stock market had some type of return. I'm going to explain what's in these cells in just a minute. So, for example, if I stuck $10,000 in the stock market the first year and it returned 3.99%, the money that I would earn from investing in the stock market would be $399. And at the end of the year, I'd have my initial investment plus the return that I gained in the stock market. And then if I took that dollar value and I started the next year plus another $10,000, I think everybody sees where this is going. But here's the real value that you get out of approaching this from a simulation, and the real value that you get from Excel. And I'll just poke my cursor in this one cell and explain to you what's going on up here. If I looked at the distribution of returns, and again, this is statistical jargon, and we do not require you to have a stats course for Business 508. So I'm gonna try to do this as in lay terms the best I can. If I graphically showed a sort of a bar chart, or what we would call a histogram of these returns, the return would look somewhat like a bell curve. Like if you have had a course in statistics, I'm sort of showing you what that looks like. It looks like a bell curve. There's a distinct peak, and then there's some values out in the tail. And so what you can do in Excel is you can say, if I had a distribution that was normal, that had a mean of about 8 and a standard deviation of 19, what I want to do is I want Excel to pull a random number out of that distribution and give it to me each year. And what that represents, obviously, is the variation that we do get in the stock market every year, and we're able to see the changes in the market. So let me, just for the heck of it, let me just pull this down again. I don't want to make anybody seasick, but for example, one year I earned 4%. The very next year I lost 30%. Is that likely? It may be, but what we know is there's a year when we could earn 4%, and then there's a year when we could lose 30%, and it wasn't long ago that we did. And the thing about this, again, is, number one, capturing the variation in the stock market. And as we invest, the next thing we want to take a look at is the timing. So as we got down to our last year of investing, what we certainly wouldn't want to happen is we certainly wouldn't want to experience large decreases in our nest egg during these years. But it certainly could happen if you're not keeping your eye on the ball. So here's what I've done. For each year, I've asked Excel to pull a value based on that distribution. Obviously, some values are more likely than others. For the most part, you'll see a lot of numbers between, if I look at 8 and let's just call it 20 for the heck of it for the standard deviation, about minus 12% to about 8 and 20, about 28%. So that's one standard deviation each side of the mean. Again, not trying to use a whole lot of statistical jargon, but most of the numbers that you'll see here sort of fall in that category. Not all of them, but most. And so, again, the variation that is been inherent in the market over the last 97 years, and will continue to be for the next 30 odd years that we're certainly investing in the market, we'll experience that. and we want to be able to capture that in the simulation. So here's the value of Excel. Based on the fact that I've added this little inherent function of Excel in here, if you go to your computer and you start hitting the F9 key, let me hit the F9 key a couple times, and what you're going to notice is that the I column, which represents our annual return, it's going to change. And this is simulation at its best, where we are estimating the independent variable here being the stock market return using historical returns. And what we get by simply clicking the button, what we have just looked at is we've looked at what could happen to our money over 30 years. And that's a pretty powerful thing to use a simulation for. So below this set of 30 years, and again, when you open up the spreadsheet, you'll see at the very bottom, there's 29 more boxes set up just like this. And so what I've captured over here in columns, or really in column N, is I've summarized all 30 years, I should say all averages from all 30-year chunks. And again, this would be the first chunk of 30 years. And again, below here, if you keep going down, there's 29 more setups just like this. And here are the averages, or the actual balances, I should say, of each of those 30 sets of years that follow in columns G through K. And so let me escape and get out of that. What we really want to notice here is let's pay attention to this cell M4, and let's see what happens to our average portfolio balance over 30 years with essentially 30 iterations of the simulation. And if you're familiar with statistics, that number 30 has some significance to us. So let me just hit F9, and what we're going to notice here looks like just over $1 million. Looks like we're settling in that area. Let's see, 1.6, that's pretty good, 1.3, 1.4. But what you see here is, and there's one where you have a bit below $1 million, but for all intents and purposes, we're probably in the 1.1 to 1.2 range, and that is if we take $10,000 a year, we stick it in the stock market, we don't do anything to it, and we keep it in there. And again, I've used 30 years. And if you want to play around with this, you can change the years. You can actually go back in here too and change your initial investment, and that'll carry through. So I hope this is a fun tool to play with. But here's what I'd like to do from an assignment standpoint. I'd like for everybody to just open up this spreadsheet and click in this cell, and just so you can kind of watch it, and click F9 a couple times. And then at some point, choose a value for your average portfolio balance. And what I want everybody to do is post that on the discussion board, and then we're going to look at the group. There should be about 12 to 15 of us in the course, and let's take a look at these average balances. I think everybody, what we're going to find here is that everybody's going to be hopefully in the, let's say, 1.1 to 1.2 range when we average these up. And again, the number 30 here has some significance from a statistical standpoint, but we're not going to delve into that too deeply right now. But again, just hitting the F9 key, essentially what you've looked at is you've looked at 30 simulations of 30 years in the average returns, or actually the actual returns, and then here you have the average. This actual balance, or this value here, is the average of all of the 30 simulations over 30 years. So listen, I hope this is something fun to play with. Obviously, if you wanted to get down to a level of granularity here where you're doing this by month, you could certainly do that. But the value here again is this: the idea that a simulation allows us to really get down and look at the variation that comes in certain independent variables as we're trying to predict a dependent variable. And this is really a perfect example, and I think one that is valuable to all of us. So I hope this is helpful. If you have any questions about the simulation, please put a note up on the discussion board. We can take a look at those questions. But again, what I'm going to ask everybody to do, just open up the file, play around with it as you wish, but then just come in here and hit the F9 key once or twice, and then just pick a value for your average portfolio balance. Put that up on the discussion board. We'll take a look at that, take a look at the significance of it, and then we'll be ready to go for the final exam. So I hope you enjoyed this. And again, any questions, please post them on the bulletin board.